But looks like it will not be a good day for Indian equity market investors because GIFT Nifty is now suggesting a steep 700-point decline for market open for Indian equities. And remember, US markets ended with cuts over the weekend, and Asian markets have also opened under pressure this Monday morning. But first up, let's talk about the US markets, where US futures have declined nearly 1.5%. That's the kind of fall that we are seeing in US futures. Dow Jones futures tumbled nearly 800 points after week Friday. So after the decline that we saw last week, the carnage seems to continue this week as well as tensions in West Asia escalate. Disappointing labor data continue to weigh heavy on sentiment. We have dollar, which is now risen to 99.5 on surging oil prices in the global market, and we have to talk about oil in just a bit because it is now scaled to that $110 per barrel mark. It is up a whopping 17% in trade today after surging 8.5% in Friday. Apart from that, Asian markets, as I mentioned, have opened under pressure today. We have Nikkei, which has declined nearly 6%. It is now nearing that 52,000 mark. It has hit the lowest level that we have seen in the last 2 months. Japan, meanwhile, has also rallied for 95% of oil supplies. And we have South Korea, which is down 6% in trade today. So clearly, across the board, all Asian markets are under pressure. US ended in the red on Friday, and US futures are also trading with deep cuts in trade today.
Shrisha, and the biggest worry seems to be the commodity and especially the oil market. And look at the surge in crude oil, because it's up almost 17%, one of the sharpest rally that we have seen of late. And well, of course, that is the biggest worry for the Asian markets. Particularly, we are seeing the carnage in some of the Asian markets that are open. But talking about specifically crude, it's a 17% jump, way above that $100 per barrel mark. And not just that, it's the natural gases, the prices over there as well that are seeing a bit of a bump up. But with respect to the safe haven demand, that is seen to be taking a bit of a backseat, because gold prices are seen to be falling right now. It's almost a 2% cut is what we are getting to see on the gold prices, while even silver today morning is down almost 4% as we speak right now, hovering around that $80 per barrel mark. But coming back to the crude price, because that is the biggest talking point for the markets. And we spoke with Iman Naseri, who's the Managing Director of Middle East Research of FGE, Nexent ECA. And he believes that West Asia tensions could push the oil to $90 to $100 per barrel mark. We are already seeing that surpassing. But he also sees oil touching to $75 to $80 per barrel mark in March before easing to $70 per barrel. Let's go across and listen in.
The prices will go from roughly $80, which is $15 to $20 risk premium in the prices, to $90 and $100 or more.
Right. And what is the base case scenario that you're working with as far as oil prices are concerned? You did take us through your target price for oil in a worst case scenario. But what is the base case scenario that you are factoring in at this point in time?
Yeah, the worst case scenario is not a high probability in our scenarios. And the best case scenario is also not our base case, but our base case is a weighted average, which I will highlight immediately. The best case is a very quick ceasefire. Iran and the US have been reportedly showing some either interest or being invited to restart talking, which could potentially result in a ceasefire of some sort together with a deal. If that kind of happen and result in a de-escalation, that's the best case scenario. And Iran has already kind of suspended its blockade of Strait of Hormuz. That, together with lack of real physical damage to oil infrastructure, is the best case scenario. The prices will immediately drop back by $10, and basically we go back to $60 to $70. In our base case scenario, a risked version, a weighted average of all these possible scenarios in front of us, we expect the prices to remain in $75 to $80 for March, and then we probably start to see the prices drop slowly back towards $70 or so.
That's the view coming in on the oil market, but let's shift focus to the biggest global story that came in overnight. Iran has now named Mujtaba Khamenei as the country's new supreme leader, succeeding his father Ayatollah Ali Khamenei, who was killed in a US-Israeli strike. The decision by Iran's Assembly of Experts signals that hardliners remain firmly in control, defying pressure from Washington, where US President Donald Trump had called Mujtaba an unacceptable choice. He, a 56-year-old cleric with strong ties to Iran's Revolutionary Guard Corps, has long operated behind the scenes as a powerful gatekeeper within the country's political and security establishment. Analysts say his elevation could deepen Iran's confrontational stance toward the US and Israel. This has led to a sharp spike in the US crude futures, which is up more than 20%, pushing oil prices above $100 a barrel amid fears of wider disruption across West Asia. Israel has also struck a major fuel shortage facilities near Tehran, while US military has reported the death of 7th American service member as the war enters its second week.
And the United States is reportedly weighing a special forces operation to seize Iran's near-bomb-grade uranium, according to Bloomberg reports citing diplomatic officials. Now, the concern stems from uncertainty over the location of Iran's highly enriched uranium stockpile, which was not being verified by UN inspectors for nearly 9 months. Now, Trump said that the US has not yet moved to seize the material, but acknowledged it remains an option.
And the US State Department has ordered American diplomats in Saudi Arabia to leave the country as soon as possible. The mandatory departure order follows drone attacks near the US Embassy in Riyadh, raising fears of a broader surge in violence across the Gulf.
And OpenAI's hardware chief, Caitlin Kalinowski, has resigned after the company struck a deal with the US Pentagon to deploy its AI models on classified cloud networks. Kalinowski said that the agreement was rushed without adequate safeguards, raising concerns about potential surveillance and the use of AI in lethal autonomous systems. Now, OpenAI, however, maintains that strict guardrails remain in place.
And Taiwan's premier has made a rare visit to Japan, the first publicly known trip by a Taiwanese premier since Taipei and Tokyo cut diplomatic ties way back in 1972. He said the visit was a personal trip to watch Taiwan's baseball team, but the move risks further straining Japan and China's relationship.
And China says that thorough preparations are needed before a possible summit between Donald Trump and Chinese President Xi Jinping as geopolitical tensions mount over Iran war and trade disputes. Now, speaking in Beijing, Foreign Minister Wang Yi stressed that US and China must work together to avoid miscalculation and conflict, warning that confrontation between the two powers could destabilize the world.
And shifting focus to the US labor market then, and US labor market showed fresh signs of weakness in February, with the economy losing 92,000 jobs, which is the sharpest drop that we have seen in the last 4 months. That's far worse than expectations of a gain of about 55,000 jobs, while unemployment rate edged up to 4.4%. Job losses were led by healthcare, manufacturing, transportation, and federal government, though some gains were seen in the financial services and social assistance sector as well.
All right, but with this time now to slip into a very short break, we'll be right back just after this quick break. Welcome back to Market Cafe right here on ET Now, and it's a sea of red when it comes to the Asian market. Let's have a look at what the Asian markets are doing right now, and let's start with Nikkei, because that is actually down 7% in trade right now. And you can look at the screen. Shanghai is down almost 1.4%. Hang Seng is down over 2.9% as we speak right now. And even Kospi, one of those indices which have seen a very good run up of late, that too is seen to be having very sharp falls in trade today. Yes, of course, the reasons are well aware with respect to the Middle East tension that are still going on. We are also seeing that even US futures are declining in trade, but add to that is the biggest worry for the markets remain to be crude oil prices that are seeing a very sharp surge, but very, very sharp cuts is what we're getting to see on the global markets right now, and especially the Asian markets. And look at the move in Nikkei, it's a 7% decline, and that is indeed big. And add to that, let's have a quick look what GIFT Nifty is doing, because the last time I checked, it was showing a cut of almost 700 points, and 730 points of decline is what we are getting to see in GIFT Nifty. We'll definitely try to see that where does the Indian markets open. But yes, the picture is not looking that great as we speak right now, Ashisha.
Okay, so that's as far as Asian markets are concerned. But let's also take a look at how the Indian equity markets closed last week. And clearly, it turned out to be a very weak week for Indian equity markets, because Indian indices ended with deep cuts. We had Nifty, which ended with a decline of nearly 3% last week. MSCI Emerging Market Index ended 7% lower last week. We had several sectors which continued to show divergence last week. So we had pharma and IT, which were down less than 2%. But on the flip side, PSU banking stocks and real estate stocks were down anywhere between 5 to 6%. That's the kind of carnage that we have seen across the board. We had FII selling that continued. So FII sold shares worth about 1.3 billion US dollars. And DII's bought shares worth about $3 billion US dollars. So clearly, dip buying continues as far as DIIs are concerned, but FIIs continue to sell within the Indian equity markets. But one of the big concerns for Indian equities that will stay with us this week as well is surge in oil prices. As we mentioned earlier, Brent crude prices are now nearing $110 per barrel. And estimates suggest that every $20 per barrel increase in oil will impact MSCI India earnings by as much as 3%. So oil prices now at 110 is likely to weigh heavy not only on oil and oil-related sectors, but the spillover effect could be seen on across the board on all earnings. And ultimately, it will have an impact on the economy and on inflation figures as well. And that is only likely to escalate going forward. So that's how Indian markets shut shop last week.
All right, that's about the market check just on Friday. But talking about some of the stocks that you should be watching out for in today's trading session, let's start the list with GNFC, because Petronet LNGs has actually force majeure, when Petronet LNG has sent the force majeure notice to GAIL, because GAIL is GNFC's RLNG supplier, and Petronet LNG cites transit constraints denting the supply of RNLG supply that has been restricted to 60%. So let's watch out for this particular counter, Petronet, GNFC. All of these counters will be in focus today. Other than that, from the other stocks and news, PB Fintech is going to be in focus on the back of a block deal, as we have the block deal details, wherein Tencent Cloud Europe BV has sold at 48.4 lakh shares at a price of 1,435 rupees, wherein DSP Mutual Fund, GS Bank Europe, as well as Tata Mutual Fund has actually bought the stake. So let's watch out for this counter. One of the recently listed counters, that is Quality Walls, that has come out with its earnings, seems to be a weak set this time around. The revenue has seen a decline of 30.5%. Loss has widened to 178 odd crores, while EBITDA is actually down 58%. And even the margins are seen to be declining from 35% earlier to 21% right now. Lupin is going to be the other stock in focus on the back of US FDA observations for one of their key plants, that is Ankleshwar plant, when US FDA has issued a Form 483 with 2 observations for their Ankleshwar facility. So let's watch out for these counters in trade today.
All right, but let's keep it going with a couple of other stocks that will be in focus today. And Karan is now joining us with a list of that. Karan, morning.
Well, starting off with HG Infra, the company's subsidiary has secured financial closure for a highway project in Uttar Pradesh. Remember, the cost of this project was around 763 crores under the hybrid annuity model. So do watch out for that. Next is Max Estates. The company has secured RERA approval for a new project in Noida. Now, this project is expected to generate total sales potential of around 2,000 crores, along with an annuity rental income potential of 120 crores. Followed by Realtel, there's a new order win for the company worth 26.7 crores from Southeast Central Railway. And remember, as on Q3, the company's order book stood north of around 8,000 crores. Next, we have RITES. The company received two major orders. One is an order worth 730 crores for a railway electrification project in Mangalore, and the second one is a 45 crore PMC order from the government of West Bengal. With this new addition, the company's order book stands north of around 9,000 crores. Next, we have a strong business update from SML Mahindra. The company reported a strong business update for the month of Feb, with exports growing 49% to 88 units in that month. Next, we have Parliamentary. The company is planning to add 25 to 30 new products to its portfolio per year over the next 3 to 4 years. And additionally, the company is also planning to double the research and development spends in the next few years. And lastly, we have IRFC and Power Grid, with both companies heading towards a major fundraising decision. So do watch out for that.
Thank you so much, Karan, for getting us all those details. But time now to once again slip into a very short break. We'll be right back. Welcome back to Market Cafe right here on ET Now. And now let's put the spotlight on AU Small Finance Bank, as the bank has received regulatory relief from RBI on promoter holding requirements as it moves towards becoming a universal bank. The RBI has removed the earlier condition requiring promoter shareholding through a non-operative financial holding company, simplifying the transaction structure. Let me take it across to my colleague Ankur Mishra, who joins in with more details. Ankur.
Yes, Reserve Bank of India has given an important breather or waiver to AU Small Finance Bank regarding transitioning into universal bank. Remember, Reserve Bank of India had already given in principle approval to AU Small Finance Bank to transition into universal bank August last year, but there were certain questions regarding the holding structure of the bank, whereby now central bank has communicated that it need not be the NOHC structure, which is called non-operative financial holding company structure, whereby promoters needed to transfer all their stake in the holding company, and thereby the entity is designed. But in this particular case, now central bank has said that if there is no other financial company in the group, that structure may not be needed, and it is seen a kind of a breather or waiver for the bank for transitioning into a universal bank. Overall, the timeline which was given during the in principle approval was 18 months. Now the bank will go back to the board and design how the structure of the company will be. But for now, since this breather of a non-operative financial holding company is there, we may see that soon an application, a final structure can be submitted to central bank, and bank may transition into universal bank soon.
Okay, so AU Small Finance Bank will be in focus on the back of this. But moving on to an ET Now exclusive, government took a stock of oil and gas in the country amid rising tensions. Sources tell ET Now that petrol and diesel prices are unlikely to increase, and Ujjwala's customers will continue to get subsidy. My colleague Prakash Priyadarshi is now joining us with more details on this. Prakash?
Well, government sources are indicating that they are aware about the fact that how the global scenario is changing. In fact, all factors are being taken into account on the issue of steep hike in LPG prices, especially domestic LPG prices. Government sources are saying that the LPG prices are being determined primarily based on Saudi CP benchmark, and there is a clear volatility in Saudi CP for last 2 months. And therefore, oil marketing companies have taken these factors into account and have decided to increase prices, LPG prices. But the government is trying to cushion customers at this point of time amid current volatility, and have tried to put less burden on consumers. In fact, they have confirmed that petrol diesel prices will unlikely to be increased going forward because oil marketing companies have sufficient stock at this point of time, and they can absorb the burden going forward. Along with that, some more factors have been taken into account. In fact, the government the government sources have confirmed that there's an interministerial group who is taking call on regular basis. Things are being evaluated on regular interval. And domestic reprioritization are taking place. just to ensure sufficient availability could be maintained in the domestic market. Along with that, the government sources have also informed that they are seeing clear sign of improvement in the global market. In fact, Iran has given positive statement by saying that they'll not attack neighboring countries. Along with that, the U.S. International International Finance Corporation has earmarked $20 billion for reinsurance, and that will support market going forward. So they are seeing clear sign of improvement, and we are expecting some positive development going forward. Back to you.
All right, thank you so much, Prakash, for getting us all those details. And moving on to another story, and now the GTRI says that rising West Asia turmoil puts India's farm exports at risk as several agri-products get exported to the region. My colleague Sumita joins in with more details.
Absolutely. Trade body GTRI has suggested that prolonged disruptions in the Strait of Hormuz could send ripples across the farm economy. They could affect farmers and, of course, exporters across multiple states. Now, let me go through the details that GTRI has shared with ET now. In fact, GTRI states that India exported over $11 billion worth of agricultural and food products to West Asia in 2025, and that really accounts for 21.8% of the country's total exports. Cereals, fruits, vegetables, spices, they have dominated exports with $7.48 billion. They were shipped to the Gulf region in the year gone by. Rice exports, again, another category which is facing a lot of pressure and could perhaps face a lot of pressure as well, given the fact that it has a lot of exposure in the Gulf region, with the exports accounting for over 36% of India's overall rice exports. Other than that, spice exports, well, they are also closely tied to demand in the Gulf, with over 70% of nutmeg, maize, and cardamom exports going into the region. Dairy and beverages, well, the Gulf relies on India for dairy and beverages as well, and in a big fashion. In fact, including 58.1% of butter exports and over 81% of beer exports. So several products, including vegetable, tea, tobacco products, and edible oils, they account for 40 to 55% of their exports to the region. And there is high exposure amongst all of these categories that I've stated. The most vulnerable remain rice exports, of course, cereals, fruits, and vegetables. So overall, agricultural activity is going to suffer, is what GTI is suggesting, if there is no sort of closure to this conflict, if there is no end to the conflict.
Sumita, thanks so much for joining us with all those details. We're shifting focus to some other stories then. India allowed an Iranian naval vessel to dock in Kochi on humanitarian grounds after it reported technical problems amid escalating Iran-US conflict. External Affairs Minister S. Jaishankar said, speaking at the Raisina dialogue in New Delhi, Jaishankar said that the Iranian ship Iris 11 was granted permission to take berth in the southern port city of Kochi after it requested assistance on March 1. Let's go across and listen in to what he had to say.
Here's the situation. You had these ships, and we got a message from the Iranian side that one of the ships, which presumably was closest to us, to our waters at that point of time, wanted to come in to our port. They were reporting that they were having problems. So my recollection is this was on the 28th. And on the 1st, we said, okay, you can come in. It took them a few days to sail in. Then they docked in Kochi. The ship is there. Obviously, the people on the ship, a lot of them were young cadets, that is my understanding. They have disembarked. They are in a nearby facility. So we viewed this, look, this ship, or these ships, because there were two others as well. I mean, when they set out and came here, the situation was totally different. They were coming in for a fleet review, and then they got, in a way, caught on the wrong side of events. For us, when this ship wanted to come in, and that too in difficulties, I think it was the humane thing to do. I think we were guided by that principle. And in a sense of the other ships, one obviously had a similar situation in Sri Lanka, and they took the decision which they did, and one unfortunately didn't make it. I think where we really approached it from the point of view of, in a sense, of humanity, of other than whatever the legal issues were, and I think we did the right thing.
All right, and moving on to another story. In India's Finance Ministry, in its monthly economic review for February, has flagged potential risks to the economy stemming from the ongoing crisis in West Asia. Finance Minister Nirmala Sitharaman remains confident that India can ensure domestic energy security and effectively mitigate the impact of rising crude oil prices. My colleague Prakash brings in more details.
Well, the Finance Ministry has come out with the monthly economic review report for the month of February, which is very crucial amid West Asia crisis. In fact, the report has made some key observations. It has noted that despite multiple challenges coming from the external sectors, the fundamental of the Indian economy is robust, and it has maintained a strong momentum in FY26 so far. The report has also mentioned that the external sector is by and large stable at this point of time despite elevated global trade uncertainties. Along with that, India's active trade diplomacy, including progress on the India-EU FTA and the in-principle agreement on the India-US trade, will have a positive impact going forward and help diversifying India's trade. Along with that, the report has also noted the US-Israel strike on Iran on February 28 and its negative impact on the energy sector going forward, which may reshape the overall energy dynamics for decades. In fact, the conflict has already driven crude prices up around 9%. LNG prices have increased by around 50% so far. But the report has also mentioned, despite the country's high import dependency on crude oil, it has sufficient foreign exchange and a low current account deficit, which can effectively mitigate the impacts of high energy prices going forward. Along with that, the report has noted that if the crisis persists for a longer period of time, it could have a negative impact on current account deficit and, of course, exchange rate as well. Some sectors will be negatively impacted, which are largely dependent on LNG and crude. Sectors such as fertilizers, petrochemicals will face hit going forward. Along with that, but the government has prepared backup plan, and on the back of strong reserves and then continuous reforms measures which have been taken by the government will maintain high growth rate, and that will help Indian economy to expand further.
Prakash, thanks so much for joining us with all those details. But shifting focus to some other stories, Central Bank has made proposal regarding small value fraudulent e-banking transactions. And Ankur, my colleague, is now joining us to tell us what the proposals are and how they can potentially benefit the victims.
Yes, as announced by Reserve Bank of India Governor Sanjay Malhotra earlier, now Reserve Bank of India has come out with guidelines for fraudulent transactions. Now, in that, the proposal is that if the fraud amount is up to 50,000, then you can get up to 85% of the value, or rupees 25,000, whichever is lower. That means the guidelines essentially say that you may get up to 25,000, but it is once in a lifetime opportunity. And also it has been mentioned that the report should happen within 5 days of the incident. Now Reserve Bank of India is going to bear the major portion of that amount. However, even banks and other entities will bear the cost. Now banks are required to resolve the fraud complaints and establish liability within 30 days. That is also a proposal which has come in these guidelines. But what happens if the fraud has happened due to the negligence of a bank? In that case, there is a full compensation which needs to be given for the fraud amount, and that is also something which has been specified in these guidelines. But more importantly, there is a proper system which has been proposed for the entities, and banks also required to send email alerts where email address is registered. Banks must provide 24/7 channels including phone, SMS and email helpline for reporting the fraud. Now these new rules are supposed to be effective from 1st of July 2026, but these are proposed guidelines. We need to wait and see what does the final framework say.
All right, thank you so much, Anko, for getting us all those details. And the second phase of the budget session of the Parliament begins today after nearly 3 weeks of recess, wherein both houses will take up the key legislative, business and discussions on major national and international issues. The session is scheduled to continue till April 2nd this time.
And External Affairs Minister S. Jaishankar will brief the Parliament today on the evolving situation in West Asia. This comes amid rising tensions in the region and concerns over its broader geopolitical impact. The government is expected to outline India's positioning and the steps that are being taken to safeguard the interest of Indian nationals in the region.
All right, but with this, it's once again time to slip into a very short break. We'll be right back just after this quick break.
Welcome back. You're still tuned into Market Cafe right here on ET Now. And let's now put the spotlight on the IT sector because we have some important commentary that has come in from the management of Infosys, which says that demand continues to remain strong in the financial services and energy sector, utility and resources, while other sectors are still evaluating future IT spending. The company added that FY26 demand has been stronger than expected, leading to upward guidance revisions. Meanwhile, Citi has maintained its neutral rating on the entire sector. Rabinder is now joining us with more details on what Infosys management had to say and what Citi's view is on the entire IT sector.
Well, as Infosys management remained very positive on demand outlook and AI front on the investor day, where they say that the financial services and the energy, utility and resource sector are witnessing a decent demand momentum, while other sectors are still in internal client discussion regarding the future IT spending. And they say that the demand for FY26 has been better than expected, which is also reflected in the upward revision of the guidance. And the financial services segment could see a further acceleration in the FY27, and at the same time clients are reinvesting the cost savings generated from AI driven efficiencies back to IT services to prepare for the enterprise wide AI adoptions. And Infosys aims to outperform its peer in the both growth and the margins. And on the AI, they say that the AI driven price deflation has impacted the industry over the past 2 years. However, Infosys believes that the preparatory AI spending across 6 value pools will help offset the impact in the coming years, and the gap between AI evolution and the actual AI adoption continue to widen as many companies face complexity and lack adequate preparation for the large-scale implementation. And this creates opportunity for the system integrators such as Infosys. And they said that they also highlighted that the large enterprises are adopting AI faster than mid-sized companies, and to capture this opportunity, the company is strengthening partnership across the AI system. And on the AI partnership, management said that the partnership with the AI players such as Anthropic are seen as a significant opportunity. While new age AI providers can develop innovative solutions, they often lack the capability to deploy at the enterprise scales. And Citi has maintained their neutral rating on the stock with target price of rupees 1440, and the brokerage ranks Infosys and HCL Tech both neutral ahead of the other large cap IT companies in their coverage.
Rabinder, thanks so much for joining us with all those details. That's some important commentary that has come in on demand from the management of Infosys, and the entire sector, remember, has been in focus ever since the AI broke out news came in, and that is likely to continue today as well. But shifting focus to another counter then within the capital goods space, and that is Siemens. The management says that the next phase of industrial transformation will be driven by industrial AI, moving beyond traditional digital twin technologies. At its Innovation Day, the company showcased AI-led solutions ranging from smart infrastructure and energy management to automated manufacturing inspections. Karan Joshi gets us all the highlights from this Innovation Day.
Well, Siemens hosted its Innovation Day on 6th of March, wherein the company highlighted the next phase of digital industrialization, moving from digital twins to industrial AI. And on that note, Citi is out with a report on Siemens with a neutral rating and a target price of 3,350. The company is positioning the group's accelerator program to embed itself early in the product design stages. The management is also prioritizing industry-specific AI solutions. The key messages from management were constructive, but the brokerage believes that the profitability would scale up largely over the medium term and the long term. The data center build-out and the renewable capacities addition over the next 5 to 7 years will create a large, localized, addressable market for the company's smart infrastructure segment. And remember, the smart infrastructure segment of Siemens is the top contributor in terms of the segment revenue. The demonstrated use cases for AI include an AI-enabled weld inspection in automotive manufacturing. Secondly, AI-driven water leakage detection in utility networks. And third, building management systems cutting energy consumption by up to 33%. The company is also partnering with NVIDIA to accelerate industrial AI capabilities in areas such as digital simulation. The company is enabling exact virtual replicas of mega facilities before construction, and consequently, customers are achieving a 10 to 20% capex reduction. With this, the brokerage believes there is scope for gradual margin improvement for the company and a potential for higher exports.
Siemens in focus on the back of that. Karan, thanks so much for joining us with all those details. But as we wind down on this edition of the show, let's get in a word from Chris Wood of Jefferies. Forget AI, the real bubble may be private equity and private credit, with 70% of private credit funding PE and illiquid loans sitting in insurers. Chris Wood warns of hidden financial stress. Let's listen into what he had to say.
There's a risk that the US stock market sells off more than the fundamentals warrant. The reason why that risk exists is that the US stock market is extremely retail driven, much more retail driven than the Indian stock market. And actually the only market I know in the world as retail driven as the US is possibly Vietnam. And the second issue in the US, which you don't have in India, is you have huge amount of passive investing.
Yeah.
I believe at least 50% of the market is passive, which means people are mindlessly buying stocks just because they're in a particular index. And that means that everybody owns the same stocks. So if the thing, it can definitely, in a panic, it can unwind much more than warranted by the fundamentals. And the other issue, a large part of the trading is done by machines. Yeah. Again, machines trade more in the US. So yeah, there's a potential for a major unwind. If the AI story, if the returns on the capex really start to be questioned. But as I say, the financial contagion effect isn't AI, it's in this private equity, private credit area. But these are, this is not visible precisely because they're private assets, they're not listed.
Well, what are we looking at? A mini subprime crisis? If I had to sort of draw out a parallel to it, what is it that you fear right now?
Well, no, it could be. Well, no, it could, on the financial side, yeah, but it's going to be, the focus is going to be on the private equity, private credit area. It's not going to be on the listed US commercial banks or the big US investment banks, because they're not at the core of this area. You see, the commercial banks have been funding private credit, but only indirectly. Key point to understand about private equity, private credit, which has been booming since 2009, is it's a massive regulatory arbitrage. They are completely unregulated, whereas commercial banks or investment banks have been incredibly over-regulated since 2009. So the private credit, private equity have been booming precisely because they're unregulated.
So a software-triggered blow-up is what you anticipate for the private.
And then the other thing they've been doing, which the market is now starting to think about, the private credit guys have been buying insurance companies and putting a lot of these illiquid loans in the life insurance companies. And that will start to become a negative focus. In fact, it's already commenced. Meanwhile, fund managers globally in the last month, this is a very recent development, they've started to think about, they've started to question all the digital platform investments they have in their portfolios. For the last 15 years, people have been increasingly investing in digital businesses away from physical. And in the last month, that started to reverse. This has just begun. Because originally when AI came in, we were thinking these platform companies their business models would be enhanced by AI. But now we're beginning to think, will they be completely disrupted? Because if you take AI to its logical conclusion, you no longer need apps. The app economy disappears.
Yeah.
I mean, I'm just saying you take it to its logical extent.
Yeah, I'm just trying to picture it in my head right now. So what you're saying is...
But for me, it's difficult because I never use apps.
Really?
I've got no interest. You know, I never really use search. I never really use apps.
No Claude, no...
No, obviously I get other people to do it for me, but myself, I have no, you know, the less I deal with this, the better, because it's all to me noise. But in the big picture, in the big picture, if this AI is what people claim, you don't need apps.
Yeah.
But obviously people have got used to using apps, so it's not like everybody's going to stop using the apps tomorrow.
Yeah.
So probably the older you are, the more you stick with what you've been doing, and the younger you are, you immediately adopt the new approach.